والهيد اوف سيشنز يتفضلوا اون ستيج بعد اذنكم. دكتور مازن أبوشقرة، مستر رافائيل زكار، ومستر فاسيلس، ودكتور عودة أبو جودة، لو سمحتوا تتفضلوا اون ستيج. تفضل. دكتور مازن. دكتور عودة أبو جودة. دكتور عودة أبو جودة. أوكي، خلينا نبلش بالجلسة الثالثة. مستر رافائيل زكار رح تقدم الهيد اوف سيشن، رح يقدم السبيكر دكتور مازن أبوشقرة، ودكتور عودة أبو جودة. الهيد اوف سيشن رح يقدم السبيكر مستر فاسيلس كاتسبيس. رايت؟ اوكي، اتفضل مستر رافائيل.
Hello? Okay. Hi. Good morning, everyone. Welcome to this session with Dr. Mazen Abouchakra, who is currently the Managing Director of January Reinsurance AG, also known as GenRe, and has been serving the MENA and East region for nearly 2 decades now. He currently leads a team of experts in biometric risk management, pricing support, and life and health reinsurance digital transformation. Dr. Mazen previously held roles in the banking industry and is part of the actuarial associations in Cyprus and the International Actuarial Association. Dr. Mazen has obtained a master's in financial engineering from the ESCP and holds a BBA in finance and actuarial sciences from Georgia State University. He earned his doctorate in business administration and consumer behavior from the École Supérieure des Affaires in Beirut. Please, everyone, welcome Dr. Mazen.
Thank you. Hello. Well, I'm going to use this one because I like to walk when I present. So, good morning, everyone. Thank you for being here. And thank for the organizer of Aqaba for hosting us this time. We always enjoy the hospitality in Jordan and the organizer, well-organized event. Today, I would like to speak in the topic about something which was very challenging, I must admit. It's basically the converging and conflicting interests between insurance and reinsurance relationship. I must admit that this topic is not very obvious. And it's not very straightforward. Very few papers were written on such a topic. But as insurance experts and reinsurers, we try to learn as we go. I try to, gather my thoughts and try to see how to come up with something which will be interesting to you. At the beginning, this is exactly what I thought. Where do I start? How do I gather the information? How could it be interesting? And what would I share with you today in the next few minutes on the, okay. So this is exactly what's happening in my thoughts the first time. Now, not to start, I start with a disclaimer. Everything I will say, it will be remaining here and nothing will commit generally to anything. So I'll start to disclaim what I will say in the next presentation. Before I give you the outline of my presentation, I would like to point out to some aspect with you, the converging structure of reinsurance. Both insurance and reinsurance have something in common. Their starting point. Anyone would like to, in the audience, would like to tell us what is the common starting points between insurance and reinsurance? Anybody would have a guess? Yes, please. Covering? Risk. Covering risk. But what type of risk? What? No, that's not unknown. Okay, unknown, uncertainty. They both covered marine. The first insurance policy and the first insurance concept and the first insurance concept both cover marine. And basically, this is why I'm not a marine expert. There is a very known expert among us, Captain Shalhoub, who's a marine expert. But marine is the fundamental, and I will share with you how and why. This is basically what I found this interesting. Now, of course, they both have the same legal structure, they have the same solvency, they are geared toward profit, they are private, they have similar balance sheet, where all subject, both insurance and insurance have the same accounting standard and the same solvency patterns and things like that. We both hire actuaries and underwriters and things like that. So all these are common. Now, because they even, like now, we have reinsurance brokers. Not only we have insurance brokers, we even have reinsurance brokers. So even on the broker side, we're also very similar. Now, since we have a converging structure, we must have something in common, but also because we deal with us a lot using contracts, we must have some misalignments or what we call conflicting situation, which we'll try to potentially discover during the presentation. So now I would like to share with you the agenda. I will go briefly on those topics. I would start by saying what is the risk, what's the etymology of risk, how the risk starts in our heads and our brain in the insurance industry. The origins of insurance, of course, the reinsurance origins, and then look at the role, how to transfer risk, and then look at the reinsurance or insurance re and see how things interact with each other and go through some obligations of both parties. Now to start, what is the risk definition? I went to the basic. The risk definition basically is the probability of an event happening and the consequences of this event. As insurers or reinsurers, we always look at the negative part, at the hazard part. We don't look at what can go well, we look at what can go wrong. So basically, the consequences that we look at usually is the hazard, not the good thing. So basically, I want to highlight the word consequences because this is basically what are the reinsurers and insurance relationship based on. We know the risk exists, but the risk is the probability of something happening. But the consequences of the risk is basically what our relationship between insurance and reinsurance are defined. Now, I don't know how many of you in the audience know that, but risk starts, if you want to look at the origin of risk, it starts from a Greek. It's called risa, or in Latin, I might not pronounce it correctly, riscere or risciare. And in Lebanon, we have a very famous rock. It's called Raushe. You know, if everybody has been to Lebanon. So basically, the rock is in the ancient Latin is basically the word risk emanates from there is how to avoid hitting the rock. In Arabic بتقول بفوق الحيط. كيف ما بدنا نفوق الحيط، صح؟ فrisk is basically managing or avoiding in the marine business hitting a rock, okay, or arriving to the land and hitting the rock. So this is how. So there must be a purposeful action, not only the event or the probability of something happening, but also the action that emanates therefrom. So avoiding the rock also comes from the marine. If you just want to see how the insurance and reinsurance relationship start. Again, I don't know how many of you know the word Botomri. Anyone have heard of this word? Botomri is also during Babylonians and Hammurabi. It was a way of also in the marine industry how to insure a ship when they go abroad. When a ship is sailing, basically, they take a loan on the ship. And if the ship does not come back, you don't pay the loan. So that was the first form of insurance, marine insurance. This is how it started 4,000 years ago, 4,000 before Christ, during Hammurabi times, and how to insure people or ships sailing. And this is a very interesting word. It's not used anymore much, but again, this is how people insure themselves. Now, as I said, the insurance is as old as society existed. There are also Indians and the other use the same Botomri type of things. And Botomri come from the bottom of the ship, the hull. So you insure from bottom up. And this is how it started. So we have here the Hammurabi in the 18th century before Christ. And the most famous current thing that we are familiar with, the insurance we do today, it started with the London fire in 1666. When London caught fire, 2 people died, but so many, 15% of London was wiped out by the fire. This is when it started to people thinking that we need to have insurance and have policies. So this is basically the origin of insurance. And then from there on until today, we didn't have much innovation. We spoke in several other conferences about innovation in insurance. We still look at the risk, at the probability of the risk, about the premium, about the things. This is basically how we deal. Now we are starting after COVID to innovate, but still the only innovation in 200 years was when Lloyd's had the coffee shop, and he invited his people to come and deal also again with marine shipment, and this is how the Lloyd's was started. So this is the big innovation that happened 300 years ago, and now we're witnessing few innovation with the digitalization. To go now to the reinsurance origin, anybody is familiar with this policy? Anyone would like to guess? This is the first reinsurance policy ever written, and I'm very proud to be part of the same organization that has written the policy because we are the oldest reinsurance in the world. That's a marine policy. That's why I was telling you before that the first insurance policy was marine, and also the first reinsurance policy ever written was in 1846. We celebrated this year the 175th anniversary of Colony, which was done in Germany. Also a vessel they were insuring the people who were insuring the vessel. So not to have a financial or a credit risk. So again, reinsurance started as a contract, as you can see, it's signed in 1846, and basically we agree with the insurance company of getting a premium, and if they want to add risk, we get again premium and underwrite the risk. So that's basically how we both are aligned together. Getting to the topic of the presentation. Now, if you look at the insurance in brief, what is the insurance? This is a swap between insurance company and insurance. There is a swap. they get something predictable. We promise them something unpredictable. So basically, we transforms risk into a credit risk. So there is a credit risk later on that we pay the claim when it happens. And it's very often the relationship between insurance and reinsurance is a long-term relationship. That's why I would like to quote our owner, Warren Buffett, and it's very important quote. It's very not recent quote. He always said, cheap reinsurance is a fool's bargain. When insurance lays out money today in exchange for insurance promised to pay a decade or two later, it is very dangerous and possibly life-threatening for the insurer to deal with any but the strongest insurance around. So it's a very important message to show how both insurance and reinsurance should be aligned and should think about the relationship as long-term relationship. Going to the second component of my presentation, basically, what are the elements? Now, okay, we know that risk is a rock and we have to avoid it, not to hit the rock, and it's marine. Now, what are the elements of risk? So the element of risk, basically, if you look at the definition, it's the process of selection and implementation of measures to modify the risk. So how can we modify the risk? We could modify the risk in several things. We can control it, we can mitigate it, we can avoid it, we can transfer the risk. Now we can have risk, we have a lot of risk financing is growing, and also now we have some risk indexing and what we call parametric risk. After COVID, we're talking more about around the world, whether on the life or P&C, about risk prevention rather than risk transferring. So all this are part of the definition of the risk. I don't know if Vasilis agree with me or not, but this is basically how we look at it. Now the insurance role is basically risk management, how to insure people from not getting, again, I'm using the rock here to be on the same pattern, how people to avoid, have a financial strain or have a financial fluctuation, so they insure the risk. So either we do risk management, another alternative to risk management is not to move from the rock and let the rock hit us, and this basically not an advisable thing. This is why we have to seek insurance, and that's the role of the insurance. I simplified here basically the company strategic objective. If you look at this objective, any insurance company must have those objectives and is subject to those risks. It could be market risk, credit risk, underwriting risk, or operation risk. The most important thing for us as reinsurer and insurance company, what we are specialized in, is the fourth risk, is the underwriting risk. Whether biometric, whether catastrophic, whether it comes from random fluctuation or risk of error, we have to really focus on the underwriting risk, not the other one. So if we want to summarize what is the relationship between us, the reinsurer, and the insurance company, what is basically converging, what's conflicting, we look at the insurance risk. We are both happy to look at it together. The investment risk, now increasingly, we look into it at the balance sheet or financial reinsurance or something. So we are looking at the investment risk. The credit risk, to a lesser degree, is becoming less and less popular, but still sometimes when you do parametric risk or holistic risk approach, you take some of the credit risk of the insurance company, but it's not advisable. But this is basically what it is. And something we avoid, and it's not reinsurable, is basically, and this is basically what is conflicting, is the operation risk. We do not reinsure operation risk. This is something uninsurable, okay, or unreinsurable. If you look at, if you want to simplify, what are the four basic risks? I couldn't find the fifth one. It's either you have risk of error, or risk of change, or risk of random fluctuations, or risk of catastrophic. And basically, as a reinsurer, with the insurance company, those are the risks the people are subject to, those four risks. And when we come in and want to help the insurance company to transfer this to us, we look at those four risks and we provide the cover and we try to stop the cover, as the picture would say, to try to minimize the loss or like optimize their balance sheet financial fluctuations. So by doing this, we are also, through insurance, we are aligned with the insurance company. We also, through comprehensive risk management as a reinsurer, we are also controlling, monitoring, identifying the risk, and also the reinsurance is a mean of transferring the risk, as we saw earlier, through asset liability management and through other means that we would look into it in a few minutes. So what is the motivation for insurance company to buy an insurance cover? It could be to reduce the volatility, to increase the capacity, to have some financial stability and less financial strain, to protect their solvency margin, to have a capital relief perhaps, and enabling them in the long run through long-term agreement to have multi-year growth strategies and tactics. So that's the motivation to buy reinsurance. As reinsurers, we have a role. Our role simply is to spread, because we work in so many continents, so many companies. Also, we do have the same let's say, structure. So this is something we are similar. It's not, we are converging into the same thing to increase the underwriting capacities, to provide know-how, expertise, stabilize the loss experience, stabilize the fluctuation, and also diversify the risk. And we do have some technical expertise, which sometimes the insurance company like to have, and basically we share this with them. I'm going fast because I don't want to take that much time from my colleagues, and I want to go now through some concept and obligation between insurance and reinsurance company. Now, when I was looking at the thing, basically the difference, one of the difference, which is interesting, is the re. Re is the difference. But we have the origin, we saw marine, but re is the difference between insurance and reinsurance, but it does not stop there. I want to look at basics, how to simplify reinsurance. So a lot of combination from this reinsurance forms between obligatory, facultative, proportional, and proportional. The converging interest between insurance company and reinsurance could be proportional or could be non-proportional. Those are other like findings throughout my research into what could conflict. So from a combination, something can come up depending on the risk reinsurance structure which we look at. And then now, when we advanced in time recently, we are talking more about parametric insurance, we're talking about holistic approach, we're talking about so many other, let's say the cat bonds and alternative risk transfer through financial market and means. So all this in a combination altogether could be conflicting between insurance and reinsurance companies and not converging at the same time, depending on the cover that we are taking. Now, if you look at the basics, when we went to school, actuarial science studies, the first thing we speak is law of large number, moral hazard, anti-selection. Those are like the buzzword. The law of large number apply to both, to us, the insurer, and to the insurance company. Basically, we have to write as much as business as possible in order to have the expected value of any event happening have less standard deviation, less volatility. So basically, to become closer to the expected value we promote. So both we have the same law of large number convergence. The second thing, again, when we all started in the reinsurance industry, we always say, utmost good faith. This is the first time. I was in my early 20s when I went into reinsurance. Okay, we have to trust each other. So trust is very, very important between insurance company and reinsurance. And what this trust, sometimes when we speak about utmost good faith, we don't have even to write it. It's implicit in the contract. It's implicit that the insurance company should and must share all the information without any, let's say, non-disclosure to the reinsurer. And we have to trust them that this information is so credible that we base our pricing and underwriting on their knowledge. So there must be this material fact exchange. And in case there is no material facts exchange, we're breaching the utmost good faith principle, and therefore it becomes conflicting. And the courts would look into that. Now, the second development from the utmost good faith from the early days is what we call E&O. So E&O came in the insurance contract, errors and omissions. So in case there is an error in the contract between insurance and insurance, it has to be inadvertent error, and we have to act on it right away and correct it retroactively from the past and make sure that doesn't happen in the future. But this error and omission does not take away our liability as a reinsurer in the utmost good faith. So those are development that would, in the contract, what we called treaty before, we used to call treaty, mu'ahadi. Now we call it contract, aqd, which is also another development in the insurance-reinsurance relation, because in the contract we must now ascertain or make legal compliance in order to make sure that we are aligned in the utmost good faith principle. One of the doctrine which everybody I think in this industry knows about is follow the fortune. Follow the fortune, utmost good faith are the two basic ABCs of the reinsurance. So I'm going back to the root. Follow the fortune also is a doctrine that makes sure that, you know, that we have no fraud, no evidence, and we have to follow the underwriting fortune of the insurance company. So the unfortunate event that could happen in the insurance company, using this doctrine, follow the fortune, we have to follow the insurance company misfortune and pay our duties depending on the reinsurance combination. But that also now, in today's world, has additional contractual agreement. It's called ECO, extra contractual obligation. So we not only follow the fortune, but if the company make error, as I say earlier, in operation and other things, we're not supposed to follow the misfortune of the insurance company if they make internal errors. So as you can see, with time, reinsurance and insurance are adding clauses in their contract to make sure that utmost good faith concept remains intact by adding certain things to support the credibility of the data. Now, why did we call it reinsurance, not insurance re? I asked myself my question. I couldn't have an answer. So I don't know if somebody could have the answer. I couldn't know. But we could call it reinsurance, insurance re, not reinsurance. We both have obligation to each other. So sometimes one of the obligations, the cut-through clause, many insurance companies would like to have cut-through clause to the reinsurance, and that's something conflicting because reinsurers don't accept most of the time to have a cut-through clause throughout their policy. They would refuse to do that because they would like to deal with the risk and the information and the output cost phase knowledge of the insurance company, not to their client. So basically that's something could create some conflict. Creditworthiness, also I'm glad our colleague Mr. Vasilis is here because this basically, the creditworthiness of the insurance company and reinsurance is very important to deal with each other because again, the reinsurance is a promise of, we transform the risk from risk to credit risk. So this is important to see the ability, and as Warren Buffett said, how can we pay our liability in the future? So this could be a source of conflict. The KYCs nowadays are becoming a compulsory at the DIFC, for example. The regulator would ask every couple of years to have a KYC done for all the clients that work in the region. And we have to do PEP tests, and we have to do a lot of tests on the KYC to make sure that the clients and the shareholding of the clients are not politically involved, or there's money laundering, or there's anything of the sort. So this is something that could be a conflicting issue between us, the reinsurer, and the reinsurers. And of course, one also growing a lot in nature is the GDPR, or data privacy. Also many regulation around the world, in the MENA as well. Data privacy is getting a lot of hype. And also as a reinsurer, we cannot keep the data unless we use it for underwriting purpose many months and years. In the past, we used to keep it 30 years. Now we have to delete it, we have to put it somewhere safe, and we have to make sure that the access to it is not permissible to everyone. Is it residing in Europe? Is it in the US? Where do you hold it? This is important, and this could create a conflict between us and the insurance company. And finally, also there are many other conflicting potential between us and the insurers, is the sanction clause or legal compliance. Each country is subject to their own legal framework, and sometimes if we work in many countries, let's say we cannot work in Cuba, or North Korea, because of sanction clause. So if you have any legal compliance, any misalignment between us and the insurance company on legal or sanction clause, we cannot do that. So those are obligations that we have now to put in our contract to make sure that we are both aligned. So alignment of interest is very important. Now, from experience, sometimes clients, and you can read this if you want while I'm talking, basically a book of business, when it's not known, they seek our expertise to help or to support or to nudge or to help them in the structuring the risk or to get the premium. But with time, the insurance company gain experience and they would say, okay, I want to change from this obligation or this insurance model to another insurance model. And this is basically how this would work, and we negotiate profit commission, negotiate things like this. Alternatively also, they could seek nowadays more and more capital relief. So many European insurance company now, because of the financial capital stress on their balance sheet, they would like to go into old-fashioned reinsurance arrangement in order to the insurance put their capital and have a capital relief. So if you want to simplify, the converging interest between cedents, insurance company, and insurer, is basically our reputation both should be aligned. We have to both trust each other, so trust is very important. Expanding the portfolio and business together, we have to work together as partners. We have to ensure the profitability of both entities and make sure that the insurance company is financially stable and have creditworthiness, and ensure the safety to other parties. So basically we have to make sure that other parties also are safe. Now the diverging interest could be either, like sometimes companies pay ex-gratia claims because they have different line of business with them and not reinsured particularly. So this basically sometimes creates a certain let's say misalignment. Sometimes the portfolio in some line of business is making profit, some others not, so it creates some misalignment. And the jurisdiction, as I said earlier, could also create misalignment. And finally, the increasing of asymmetric information. We live in a digital world, and the information now, the credibility of it and how fast the company wants to act, sometimes creates asymmetrical information, and this go to operational risk. So again, the operational risk is not something we can reinsure. So to summarize, reinsurance and insurance company are partner. This is a partnership together. So this is something, and I put the ship together because to go back to the marine. So as I said earlier, marine insurance is so we are partner in the ship concept. And for direct insurance, and insurance is it's a powerful tool to have a good, stable financial position. It's a method to transfer the risk, and it's a compensation also for the services and expertise the insurance provide to the insurance company. But again, all three form this partnership. Now, again, towards the end, I would like to quote Warren Buffett. He mentioned, only when the tide goes out do you see people and discover who are swimming naked. So when things are doing well, you think everybody is well and a good thing, but the creditworthiness and the liability of the insurance company only shows really is when things go wrong. So we have to be careful and work with the best insurance company or reinsurance company. So an ounce of, to quote also Benjamin Franklin, an ounce of prevention is worth a pound of cure. And I would like to have a small eye to the future. Would we have, like we have digital bank, we're having some digital insurance company. We would see terms now in the future, block reinsure or crypto insure or something like this? This remains to be seen. But the most important message we get from COVID, whether on the PNC or life or medical side, prevention is important. And the best thing is the well-being of the company and the well-being of the people would create the best atmosphere environment for non-conflicting issues between insurance and the insurance company. And I thank you very much. Any questions? Do we have? Yes, Mr. Lutfi. They marry each other. Partnership. Yes, تفضل سمير.
The era of a new customer that has a new need after all what happened since the 3 years after the COVID and so many things happened before. So from your point of view, what else in the insurance industry, when it comes to the customer need, we have to do? Thank you very much.
You're absolutely, Mr. Samir, you're absolutely right. I mean, the innovation, and this is something I think before COVID, we look at the innovation, real innovation in the insurance industry. We are known to be traditional insurance. The insurance industry are known to be traditional industry. And the only innovation we really have, it was the Lloyd's Cafe. This was in 300 years, was a major that, he did something which had repercussions until today's world. After COVID, things are accelerating. Now the distribution models have changed. The innovation will be how to distribute product through digital. The wearing of, let's say, those wearables, and how, for example, in the car industry, the telematics are innovation. If you look at the US and other countries in Europe and around Africa even, and some Asian country, very few in the Middle East, we talk about digital insurance companies, so paperless, no physical presence. But again, the regulator have to be also up to date with it. One of the issues in the Arab world and the region is that the regulator always behind the, let's say, the innovation or the technological. So one of the things, sorry?
The commissioner is very conservative regarding the insurance.
Exactly. So this is one of the things we are lacking as an Arab world, that we don't have a regulator who are thinking proactively ahead of time. Let's say e-signatures and all these things, no wet signature, and something of the kind. However, COVID, the good thing about COVID is it has accelerated, it acted as a catalyst for the innovation, and we're seeing a lot of telemedicine on the health side, telematics, and things are moving, but the major innovation are becoming in the distribution rather than the fundamentals of insurance. And also we're seeing things, for example, on the reinsurance side, we're seeing alternative risk transfer through financial like a bond, like the cat bonds are increasing. So the risk transfer through non-traditional means are also changing in the world, and the distribution models are changing. And we're doing innovation that in the sense that we are getting before we used to do insurance policy customized to a large population. Now we're doing something what we call ecosystem insurance policy designed for Mr. Samir, yes, for you, yes, based on your behavior, based on your preferences, based on your belief. And we can get to you from the data which we gather from social media and other things. So this is and even the underwriting is changing. Before, for example, just if I have one example before I leave the floor to my colleagues. For example, let's say as an anecdote, a Ford Bronco, if everybody knows the Ford Bronco, if a male, non-married, driving a Ford Bronco, apply for life insurance, we'll give him a loading. If a female driving a Ford Bronco, married, we'll give her a discount without having to underwrite their health. Why? Because from statistics, we found out that male who are driving a Ford Bronco are usually overweight. So therefore, they have substandard risk. While ladies who are driving a Ford Bronco and married, they drive the Bronco for safety for their family, so they are risk averse. We give them a discount. So using non-traditional medical or life underwriting parameters, we're able to underwrite people without getting into their health data. So those are innovations are happening as we speak, and it's a big leap for us to get there. And there is a lot of resistance from the industry to remain at our comfort zone.
Thank you very much.
All right. Mr. Abouchakra.
يعطيك العافية مازن. Very good presentation. My name is Khalid Abu Nahil from Trust Holding. Very nice presentation, Mazen. You reminded us of what we forgot, how the insurance and reinsurance started. Very systematic, very brief to arrive to what challenges or conflicting interests between insurers and reinsurers. In my view, always been there was a conflict between insurers and reinsurers, even before the catastrophes or the pandemics or environmental changes. The gap is between a developed environment and between developing environments. The gap between changing and the ability to develop the legal framework and between the developing countries and the developed countries. There is a gap. Learning from developed markets like the basic insurance principles, it's more developed, and in my view, in our developing countries, the legal principles are not fully covered under their legal system. So implied conditions like utmost good faith or insurable interest cannot be taken as a valid ground to exclude claims in the court system in the developing countries if it's not covered under a specific law or under specific conditions in the policy. This is a major conflicting interest in my view. The change is, in my view, the ceding companies as well, by imposing sanction clauses on the treaties or at the renewal of the treaty, the ceding companies are already undertaken risks and already protected insureds and insured events. Should an event arise after the sanction but undertaken by the ceding company before, there is a conflict in interest and the ceding companies are left without protection. So this could lead to bankruptcies of local insurance companies. And this is fair to say that there is a need to protect for such contingencies and conflicting interests of the countries that imposing these sanctions and the protected companies in the sanctioned countries. As far as the local company is obliged to comply with the covering any loss that under sanction. And this is a major exposure that the local companies face in our markets. These are really is going on, and it's going to be all the time, and the development and the innovation and the marketing and establishing or running after a market share affecting the line between insurable and non-insurable risks. In my view, even the definition of economic loss that should not be insurable, we see that the insurance companies are made to pay economic losses on the ground that it's not specifically excluded. This is a risk that we all live.
This is basically when you look at holistic risk transfer, we look at the entire balance sheet or look at parametric insurance now, we are looking at these kind of risks, what are the trigger or the indices we are using that would trigger the risk to start being insured either in the financial market or as an insurance. So there are answers for like uninsurable economic risk before that are now in the market available, and it has a price. But are you willing to pay for the price to get the protection? This is the other thing, for the gap.
Of course, but it is at the underwriting stage you did not anticipate the magnitude of the exposure, because in my view there is in risk management the identification of exposures or risks there is a risk that should be put in the top priority, the risk of lacking or not able to identify risks, the risk of not being able to identify risks, because we do react to what happens and materialize. And even the catastrophes and reaction of reinsurers on the ceding comes by raising or reducing commissions, restricting terms, depending on the conditions, as a reaction of past experience.
Yeah, but
past experience should have the premium, past premium should have covered these risks.
Yes, but in the four risks which I put, the risk of change, error, random fluctuation, catastrophic, risk of change is very important, and it has to be back to back between the insurance and insurance company. And this sometimes in the insurance company level don't put it. When you have risk of change, a change of flow, a law has changed, they increase taxes in the middle of the year, which happened in Saudi and the UAE, they put VAT in the middle of the year. So if you didn't collect VAT before, or you didn't, so you have a problem. So risk of change has to be transferred to the end payer. And this is basically the alignment between insurance and reinsurance should be always credible and transparent in a way, and not to have those gaps. If we identify through risk management committees what are the different gaps that could happen in the treaty wording or the contract wording, we could avoid by not having back-to-back. Where the conflict starts is when the insurance company want to compete and they say, okay, it's not going to happen, this will not happen ever, so they will take the risk on their own. And we saw September 11, the black swan theory, things does happen as a black swan. So that's remains to be seen.
Thank you, Mazen, very much.
Thank you. I think I'll take one more question because I don't want to take more time, but it's interesting discussions. If you'd like to answer some of the questions as well, feel free.
Take all the time. I'm going to bore them to death.
All right, one more question.
Thank you, sir, for the presentation. My name is William Consul from MetLife. I think the most important word that occurred after the COVID is agility. Can you describe from your point of view the relation between insurance, reinsurance as an agile relationship? And the second point, you have talked about the regulation. And again, agility should come to the surface again. Do you think it's the responsibility of the insurance or reinsurance companies to take the first step to make this regulation or these guidelines or this relationship like the first initiative or the first step?
Okay, for the first question, agility is not something new. It was 2001, which they created the manifesto of Vienna, if I remember correctly, which they created the word agility, and basically it's an alignment between performance and how the management alignment. And the more, let's say, better performance and more aligned between the employee and the management, this is when you are agile. So basically, agility in a partnership, to answer your question, if we have a good partnership based on trust and sound transparency, agility is easier to implement rather than having like a black book and not non-transparent. So maybe this is the first question. So it is our duty to both be transparent and have established trust in order to be more agile into making a product to market and to answer the client needs. In terms of regulation, I mean, as far as Gen Z is concerned, I can speak. I've been in the company for 24 years now, and I've been participating with several conferences, and Mr. Lutfi could testify that we have always, when we finish the conference, I personally, I like to have what are the takeaways. And most of the time, even in the last Dubai conference we had with the Gulf insurance effort, always the takeaway is how can we approach the regulator and make them do things faster. But they don't listen. I don't think they listen to the federation, to the association, to the insurance. They don't. They have their own agenda. Sometimes we do invite them for conferences to be part of us and try to understand where we're coming from and how the regulation could benefit the people of the country better, and how to, because insurance for us is a business, but for the economy of a country, insurance is a major financial instrument for the GDP growth, for the protection of assets, for the country. If you have weather hedge covers, or you have those, you know, like new ways of protecting the agricultural people, this is good for the economy, yeah. But the regulator don't seem to. They are living. I'm not the criticizing them, but sometimes they have their own agenda. It could be political, it could be I don't know what. Like for example, I can name a country which I think they're doing a lot of work. It's Egypt. Egypt, with the new government, they do a lot of regulation, helping digitalization, helping the mandatory covers, bil afran, and doing a lot of, for people traveling outside Egypt, for example, not to have problems when they come back if they are disabled. So there are countries like Egypt and of course Saudi Arabia with Sama, and now in the UAE also, they are like even in Jordan, the central bank is taking over the regulation. So hope, because the banks are usually more agile than the others in the transformation. So hopefully now in the Arab countries, when the central bank are taking over the regulation, we could see a birth of hope. All right? Thank you so much.
مساء الخير جميعا. Good evening everybody. First of all, I would like to thank you for being part of this event. We at Jofico are very proud being a main sponsor for this event, and allow me to thank the organizing committee, its members, Mr. Maher Hussein for his great job that he conducted to get this event as you see. Many thanks for Dr. Moayed Al-Klub for his efforts also, and wishing him the best of luck in his new position. As you all are aware of, that the coming challenge for the industry in the region is applying the new standard of reporting our financials, which is standard 17. This standard is described by the expertise as the golden standard. But I think it's not going to be the golden standard for us in Jordan, neither in the emerging markets. Luckily, we have today Mr. Vasilis, which is very known for all of us. He is one of the expertise who is going to give us a clear idea and definition of this standard. Allow me to give you a brief idea about Mr. Vasilis and his experience. Mr. Vasilis is based in Dubai and is the General Manager Market Development of AM Best for the MENA region, South and Central Asia. He has been with AM Best for the last 12 years, having joined the company in London as a Managing Senior Financial Analyst and growing to the position of General Manager. Prior to joining AM Best, Mr. Vasilis was responsible for alternative distribution channel for General Electric Insurance Solutions. He has over 20 years of insurance and reinsurance experience, having focused on both life and non-life. He has held roles in high-level operational and strategic positions for most of his career. Mr. Vasilis holds an MBA from University of Wales and a bachelor degree in economics from Bureau's University. Mr. Vasilis will address the following points: the concept of the new standard, how we got here with this standard, what it's going to look like with the new standard, and the implications of implementing this standard in the emerging markets. He will be more happy to reply to you or to all your questions after we finish the discussions. Mr. Vasilis, are you ready, my friend?
Want to?
Go.
Okay. I'm with you. I don't know if my presentation is with us.
Okay.
Beautiful. So, after a beautiful presentation from Mazen, as I said, I'm going to send you to sleep by speaking about an exciting topic as IFRS 17. So I want to start a little bit strong. So I want any one of you who understands or believes he understands combined ratio to raise his hand or her hand. Nobody? Okay. Okay. If you believe it, you don't have to be a rocket scientist at it. Just do. I was hoping for more. How many of you think your board understands combined ratio?
You what? You are what?
Your board members. Okay. Were you raising your hand before?
Yes.
Okay, good. Okay. Let's see where IFRS 17 will leave us. So, IFRS 17, why? How do we? So, we are going to cover a few points. We will start with how and why we got here. Let's progress, please. Yeah, the next one. So, we started the journey to developing IFRS 17 because there were several inconsistencies. As a matter of fact, I had several meetings this morning and several of the companies were complaining about someone else who is booking things in a different way because IFRS 4 allows them. So that was one of the major reasons why ISB said, well, we need to have something more consistent. I'm all for it. There was also asset and liability mismatches, and especially for life business, because you would have, as we will see, different valuations on the asset side than the liability. And when we're talking about life business, life insurers and reinsurers were those who were trying to develop ways of evaluating market values for their liabilities. And you know, you do remember things like embedded values. You do? For those of you who do not, embedded values was something that actuaries loved to calculate. I mean, it was like the actuarial Olympics. And they all had a market value which was not always consistent with the one next to them. And then quite a few of the market values were either way away or very close to the book value. So this is trying to make some sense out of it, which again is a very good point. And a third point was that accounting for insurance was very weird, even for those who are reading balance sheets and P&Ls, you know, and they decided that we need to bring something that is easier to understand by the investors. And that's the main reasons why we started. And I think if we take each and every one of them, we will all agree this is a perfect reason why you need to change your accounting standards, because you are in a position but it doesn't work for you, it doesn't work for the market. Yeah?
And apparently this didn't work either. Thank God I shout a lot. So can we move to the next slide, please? We talked about the other reporting standards, and because the accounting did not work very well, more and more companies were focusing on cash. It was easier to talk about, but equally it wasn't value creation. And it wasn't just for life business, it was for any type of long-term business. You cannot really evaluate that, see the real value of the business that you have on your books by looking at the IFRS 4. And even people who were standing very senior in the insurance market were having problems understanding what the numbers told them. So that is why we started looking at IFRS 17. So what IFRS 17 will look like. Yeah? Can we move? First of all, we are going to have market values on both sides of the balance sheet, especially for, as I said, for long-term business. That is valuable. Where it starts getting a little bit hairy is the fact that there are no rules. This is principles-based. And again, our experience has shown that principles-based rules, regulations work pretty well in some of the advanced markets. It's a big question mark when it comes to some of the emerging markets. That also means that you depend more and more on auditors and external consultants. The other thing that is pretty critical is that under IFRS 17, there is no day one profit. Essentially, you set up your contractual service margin. What that is the profit that you expect to make over the period of the contract, every part of the contract that spills over from this year, and you slowly unwind it during the duration of the contract. Again, that is an interesting concept, and it's something quite new to the accounting. I will not talk about the differences from embedded value because the majority of these markets are not, the emerging markets in this part of the world are not having great representation of life business. But suffice it to say there will be significant differences from that calculation as well. The other thing is that according to the regulation, you are supposed to group your contracts in different groups. These groups need to be on a, these groups on a 12-year period. So the contracts that you wrote this year need to be grouped together. And you definitely need to group the ones that make profit away from those that you expect to make a loss. And that is pretty critical because we all know in every market there are certain products that are making a loss. So talking about Joudeh, and we will come back to that, MTPL is one of these contracts that you need to group separately and report separately. And that, as we will also see, is critical to how quickly you recognize profit out of these contracts or otherwise. And I think one of the major challenges when you implement this IFRS is that you will need to depend on new data. And in markets where data is one of the weaknesses to ask
for development of new data and capability of capturing that data. Away from what anyone will tell you, this is going to be one of the major challenges. There is going to be a need for significant investment in order to be able to capture that data, and then another investment in order to be able to keep on having it and explaining it to all the key stakeholders. Can we move to the next slide? In all this, there is a discount rate. So the liabilities are actually going to be discounted. And there is a lot of opinion around it. There is the opinion that is going to help companies be more reasonable in their pricing in the market. I have my question. However, the fact that you have a discount rate, and that is a principles-based, and it targets some kind of market value, it asks the question, where do you get the data? And are all companies going to have the same market value? In the developed markets, there will be companies that can argue they have a reason not to follow the full market. In the emerging markets, like Jordan, I don't think there is enough information to come with the right, if there is such a thing, discount rate. And here comes the second key takeaway I want to have from this. You will depend even more on external sources like your accountants, like your auditors, to tell you what is the right, or your actuaries, to help you calculate what is that discount margin. Now, I will not spend too much time on the fact that it is both top-down and bottom-up, but I think we need to think about it. The fact that in order to develop a standard that will be better for you, you have to spend a little bit more on your external consultants. On the other hand, it is not so bad in my view, because you will have some imported expertise, as I will call it. In other words, they will be speaking to their colleagues in the markets where they have done a lot of studies to help them calculate what is the discount rate, and probably, and that I need to underline, the whole market will follow the same kind of discount rate. It will be a consistent one. Some companies may argue they will benefit or not benefit from it more or less, but I think in emerging markets we may get consistency through the back door being the consultants assisting the companies. Can we move to the next one? There are three approaches to calculating the discount rate. For non-life business, the bottom one is the one that applies. It is for 12-month contract, and there are different principles which you need to follow. And I would like to move to the next one, please, because this one starts showing you what your balance sheet will look like. Now, one of the major reasons why all this is happening is in my mind, is what you can see on the top left. You see on the asset side, in the current balance sheet, you had all your assets and you were having this deferred acquisition cost. Majority of that was for life business. Now this one is going to go away from the balance sheet. It's not going to be an asset, it's just going to reduce your liabilities. On the other hand, where you have the claims provisions on the non-life side, this is going to split it up by best estimate claims provisions, which will be discounted, and then you will have the risk adjustment and the contractual service margin. So every time you write a business, you calculate what's the liability, you say that's the risk adjustment, and that's the contractual service margin. So liability, risk adjustment, and profit if you wish. So going forward, when we talk about combined ratio, this may start getting less important, and you will be looking at the contractual service margin and how it is developing. You told me this business will make profit. Is it still making profit? Unfortunately, the new standards do not force you to report the unwind by year. So if you told me that you will make 10 million out of this year's business, you don't have to tell me that you did make 10 million next year. So halfway house for me. Can we? So the P&L will look a little bit like this. You will have the underwriting profit, which will have the expected claims and expenses, less the actual claims and expenses. So it's the whole unwind. You will have the investment profit, and then you will have the contractual service margin amortization, and that will be your P&L. At no point will you see premiums, will you see claims, will you see expenses on this one. So, if your board does not understand combined ratio, that's good, goes away. If, however, what you do understand of your running your business is about claims ratios, combined ratios, and so on, then you have to look into the notes, which will be having all the things that we know how to calculate. But again, the devil, as they say, is in the detail. So can we go to the next slide? There are two ways of calculating claims ratio and combined ratio. All that in the name of consistency. I'm going to lose consistency here. So the first one is the second one in these ones. I'll go to number 2. If you see what is the combined ratio there, it is gross claims minus reinsurance recoveries, so it's net claims, over net premiums, because it's gross premiums minus reinsurance costs. So that one looks like today's combined ratio. And that is called net-net. And the top one is looking gross claims plus reinsurance minus reinsurance profit or plus loss over gross premiums. So this sort of the same, but over gross premiums. Now, as I said, the devil is in the detail, because you see, when you write a reinsurance contract now, when you give business to a reinsurer, what happens is the reinsurance premiums that you pay reduce your gross premiums. So you have gross minus reinsurance comes to net. If you get reinsurance commissions, that reduces your acquisition expenses. It's a negative expense. And if you get profit commissions, again it goes as a negative expense. No. IFRS 17 cannot have that. So if you get reinsurance commissions in the future, it will reduce reinsurance premiums. So your net premiums before is not exactly the same as the net now. And on the other hand, your profit commissions will reduce claims. Wow. All that for consistency? What is the consistency? If we go one step further, for the changes that I mentioned, we have on the left-hand side the net, and on the right-hand side we have the net gross. And these are comparisons to the existing ones. And we looked at what the impact of the ceding commissions will be, the profit commissions, reinsurance loss or profit, and the dollar swap. The dollar swap is something that you all know. You know, if you have a contract that you reinsure, let's say on a quota share, and it still is profitable, and you reinsure it on a quota share basis, the net effect shows better than what the gross one is. And as you will see, depending on which of the two methods you use, it has a different impact. And if it looks a little bit complicated for you, we have done some analysis. Can we go to the next page, please? The blue line shows you the combined ratio that you report at the present moment. Yeah? The normal standards. The green line shows you the net gross. The red shows you the net. So what do we learn? We learn that under certain conditions, you benefit in reporting one standard versus the other. And I think as the time goes by, companies will be quite aware of that, and they are going to utilize it. And for those who are not within the company, they are doing comparisons, analysis, and so on. They will need to go more into the details to see how all that is calculated so that they will be able to start comparing companies. Yeah? The only benefit, no, there are many benefits, but one of the benefits in all this is that you will be able, from the reporting, to see how profitable the reinsurance contract of that company is going to be. So I think that can be quite tricky because it may also change practices in the market. So, for example, I'm a competitor of Mazen's, he's got a good client, and now I can see how good he is. So I go and I offer better terms. So Mazen needs to defend that business, which was paying for another contract that maybe doesn't make that much money. Not everybody is going to win from that kind of transparency. And moving on to the last page of this section, this one shows you the profile of how business is making money. With the blue one, you have the current system. You write the business, you put it on the books until you put some reserves next to it, and until you pay claims, and if you don't change your reserves, you make some money at time zero that you write the contract, and smaller parts as you unwind your liabilities. With the future, in the future, that is going to be amortized throughout the contract. And that means that profit recognition will be slower. Now, if you think that is small issue, wait until you report the first 2 years to your board and you try to explain to them that you are not doing anything different. It's just the profit profile that changed, and therefore you cannot pay them dividend.
Sorry, the difference is the DAC is a difference?
Huh?
The DAC is a difference in the blue line? It's DAC mostly?
The difference between the blue and the red is the difference.
DAC mostly?
It's not DAC, it's the different timing.
Yeah, but it's because the blue line, the first is like high, so I think this is DAC. It is because you are not allowed to recognize profit at time zero. So what does that mean for emerging markets? If we go to the next slide, one more, please. This is the balance sheet of the Jordanian market as at the end of 2020. So, where are we going to see changes?
First of all, if we look on the liability side, the insurance provisions, the 810, that is going to change significantly because you are going to split that into the future provisions plus the CSA, say, plus the risk adjustment. On the asset side, you're going to have, as we will see, probably change in reinsurance recoverables. You are definitely going to have changes in the assets, in the invested assets, not because of IFRS 17, but because you will implement IFRS 9 in the process, and that will also change the recoverables, as we will see. So quite a few changes. If we go one step further, the next slide, this is the technical account. So what we have here, we have a market that starting from the bottom, combined ratio of 96%. Why is it 96%? Because the acquisition ratio is -2. Why is it -2? Because of reinsurance commissions and profit commissions. Well, that one is going to change significantly. That one is going to change significantly. And we think that it's going to add a little bit into the combined ratio. So we have a market that has, on the face of it, a good profitability. But if you take out reinsurance, I wonder how profitable it is. And if you start reporting to your reinsurers and each and every reinsurance how profitable or unprofitable the business is, let's wait and see what happens. So we go to the next slide, because as we said, reinsurance is very critical for the profitability under IFRS 17 of markets in this region. And it is important that your insurance contract matches in terms of duration and in terms of generally the valuation models and the boundaries and so on with that of what you have. Now that is more of an issue for long-term products. So in most cases it's not going to impact 90% of the business written in this market. But you need to be very careful, because under certain conditions the impact of reinsurance can be reduced. And what is quite certain is that the profile of your profitability out of the reinsurance contract is going to be biased towards later in that contract from what you have now. So be careful, because that is going to be one of the areas that is going to change. If we go one step further, this is the combined ratio of the companies in the Jordanian market, and they range from 78 to 120 almost %. As we know, one of the key elements of the challenges in the market is MTPL, motor third-party liability. I understand that the regulator has instructed you to separate the MTPL part out of comprehensive insurance. You know why? Because IFRS 17, in all of its provisions, it may not be too descriptive, but it says you have to report separately the onerous parts of contracts, the onerous contracts. So you have to report MTPL separately. And what happens to MTPL, to onerous contracts? Under certain accounting practices at the moment, you may show some benefit in the first year until your claims start arising. Oh, come IFRS 17, you cannot do that. It's onerous, and we all know that onerous means you cannot make money. Your future cash flows end up into negative. So you cannot take any money out of it. So whatever profit you report out of MTPL that you may have written this year, that goes out of your P&L. And suddenly, the combined ratio, even if you didn't change anything else, for the whole market goes way up. So that's another benefit that you're going, benefit? you're going to get out of IFRS 17?
Benefit to who?
Huh?
Benefit to who?
Exactly. Well, because I like to be optimistic at times, it may be a pretty good way of pressurizing the authorities. Your shareholders, I think, understand it. But the authorities, the regulators, and whoever else will listen to say, hey, you know, we thought we were making that much money. Under this one, we're making much less. And if we continue like this, you are actually going to force us to get out of business, out of writing this business. I don't know. So this is another main area that we expect to change. Move to the next slide. The final point I'm going to talk to about is outstanding balances. And that is not because of IFRS 17 itself, but it is because of IFRS 9, which says that you have to provide for balances that remain outstanding for a long time, and provide means write them off. When we look, we do not have the exact aging, but we can get some indications by looking at the amount of balances that remain outstanding at the end of the year. And you can see that for the whole market, it's hovering around 200 days outstanding. If you apply something like 90 days outstanding and you write off all the rest, that is going to impact your capitalization. Serious stuff. So, concluding. We started with, 2 slides further down. We started with the premise that we will do IFRS 17 because we have inconsistency. Well, inconsistency will remain. It will remain because you will change the way you calculate some of the key ratios. It will change because we don't know how consistent the discount rates will be between companies. God knows how you will be able to evaluate if discount rates between 2 companies in different markets are consistent between them. And of course, as I mentioned, the assumptions that are being used for some of these calculations will be questionable anywhere, but even more in emerging markets. Relationship to market values, I think here is where this standard scores well. But as I said at the beginning, that's more of a life issue. You are more of a non-life market. So it is a great bit, but a great development. We hope that we will not have the mess we were having with embedded values. But that's not an issue, never was an issue in Middle East. And the other thing is the image of public financial, of insurance financials in the public. Well, forget that. I don't think we will understand the reporting when it comes out. We are in the industry and we will have to study hard to understand what we are reporting. And the last slide, please. As I mentioned, new data. New data is the big challenge. Everything else are minor issues. We will eventually get there. But before we get there, you will have to spend big in order to develop the quality of the data, because we do know that in most of the markets it's not good. And I don't think the processes are there, so they need to be strengthened. And the final thing is, I don't think we have, as markets, the quantity of expertise to make that leap forward. So, a tremendous standard, but I don't know how much benefit it will do to the market in the beginning. Thank you very much, and open to your questions. Yeah? Yes.
Thank you very much, Vasilis, for the... Hello?
Is it on? Is it on?
Yes. Thank you very much, Vasilis, for, as usual, very pleasant presentation. You started by saying that you are going to be strong to make us sleep, but in fact we proved that we are awake and listening very carefully to a very good topic. Actually, is in the table of every board in the world, actually, not in our area. Maybe some companies are not, or some markets are not giving it that much attention. But in fact, as a board member in several companies of our group, I face a problem that even standards change very quickly. And this is by itself is a challenge and misrepresenting the actual facts to board members and to shareholders, even affecting value of the shares and the decisions in investing. And it seems to me in some markets, ultimately, we don't know the actual market value of the company unless it's run off in the future. So we'll wait until the future to decide to buy or not to buy. And this is a dilemma that even investors in insurance sector may reconsider and say, why go into the uncertain where I can see some certainty, better certainty in other industries. That's by nature, without the standards, we have a problem that we price our premium income based on something unknown to us into the future, based on a past experience that proven is wrong by every year and every year. So this is the dilemma that I think. The second point that I would like, and even with due respect to the accounting industry professionals as a profession globally, that failing to create or anticipate the standards to reflect the correct financial position of the companies that listed in the stock markets, this is a failure from the accounting profession in my view, or the Association International. But at the same time, the correction of the situation is also made by the accounting profession at a high and hefty fees, because I see cost of complying with this takes 2 years, maybe with a cost of like $500,000 for small companies are really taking out the profits. In my view, this is my comment and the questioning for you to address, and maybe we can benefit from them. Thank you very much.
Thank you. I think that at least on a high level, the profitability going forward will have one additional metric, and that's the unwind of the CSM. So that, we hope, will be a better measure of how profitable the business that you wrote was. And it will also help give an indication of are you writing more profitable business now than before? On the issue of accountants, I think I have heard everybody blaming someone else. At the beginning, they blamed the rating agencies. We also blamed, not we, they blamed also the accountants, the regulators. What did the board do? They are first line of defense there. Who persuaded the accountants to book one thing like this than the other? So I think we all have our own fair share when things go wrong, the same way that we have our own fair share of the things when things go right. Do I think this one will make things better? I'm not that naive. It will be, we will still have failures of companies. We will still have things misrepresented. We will still have finger pointing, it's his blame, his blame, his blame. It's just another standard. And in the meantime, you know, we will be, I think, it's like when you go from the good light into night without your lights in your car, there will be a period that we will be driving thinking we know where we're going, and indeed our vision will not be that good. Any other questions? Okay. Thank you very much. Yeah, Mazen?
Yeah,
I have one question, just like the
Yeah.
I mean, I understand that the person is principles, right?
Yeah.
And if I can make a combination, is like a potential FCAA combination of rules-based, FCAA-based, whereby the country would say, okay, this is the guideline, this is the discount rate, this is the thing, this is what you need to apply. And if you're not something different, you have to prove why you use something different in a transparent manner. Why can't you do that?
It's a nice idea. It's just that at the present moment, it's like all countries are going for IFRS 17. I think they're going for IFRS 17. I can understand the Europeans. Everybody else, I have a big question mark. I think it's because we don't know anything better and we go for it. Personally, I think, in my mind, it has so many gaps that the moment we implement it, we'll be talking about IFRS 17, 18. That's me. And if it doesn't happen, I don't know. I'll be surprised. Thank you.
Thank you, Vasilis, for this valuable presentation. Thank you.
شكرا للدكتور مازن أبوشقرة ومستر روجر أو عفوا رافائيل زكار، وأيضا لمستر فاسيلس كاتسبيس ودكتور عودة أبو جودة. فلتتفضل الدكتورة لانا بدر عضو مجلس إدارة الاتحاد والمديرة العامة للمجموعة العربية الأوروبية للتأمين لتكريم السبيكرز والهيد اوف سيشنز. دكتور مازن أبوشقرة. والهيد اوف سيشن مستر رافائيل زكار. مستر فاسيلس. ودكتور عودة أبو جودة. شكرا لحضرتكم. شكرا دكتورة. صورة. شكرا لكم، شكرا لحضوركم. بس بدي ارجع اذكر مره ثانيه بعد اذنكم، اليوم الحفل المساء بسرايا بالمناره، فبتمنى على كل الموجودين انه الدخول رح يكون عن طريق الباج، فما تنسوا الباجات وتفضلوا على الغداء، وان شاء الله بكره بتجدد اللقاء فيكم.